Hello there and welcome to Business Bullet. I'm Robert Miller. Well, the gloomy mood hanging over global stock markets hasn't gone away, I'm afraid. Traders in Asia had the first chance to react real-time to the US Federal Reserve Bank's latest economic turbo booster. It's called Operation Twist. This involves buying up to £260 billion worth of longer-term treasuries or US government bonds, and they'll pay for that by selling short-term treasuries with 3 years or less to run. In theory, this should push longer-term interest rates lower and ease some of the pressures, at least in the US financial system. And at home, as we reported on Wednesday, the minutes of the September meeting of the Bank of England's Monetary Policy Committee show that QE Mark II, quantitative easing or more electronic money, is on its way. But to achieve maximum effect, QE2 has to come next month in October. If it doesn't, then I'd be very defensive in your investment outlook. Now here's another sorry story of dithering Eurozone officials and why I think you should still avoid continental and UK bank shares as well as wider financial sector shares. The European Systemic Risk Board, yes it's really called that, of central bankers and regulators, has warned that the interconnected nature of the EU's financial systems, linking the Eurozone government bond markets and the bank funding and wholesale markets, means that the risks of contagion or the domino effect are very high. And to underline that point, the International Monetary Fund's Global Financial Stability Report predicts that the Eurozone's sovereign or government debt crisis will spill over into the banking sector precisely because of those interconnected relationships. But the EU Single Market Commissioner, Michel Barnier, insists the banks have enough capital to withstand a shock. I don't know what planet he's living on, but they don't. And sticking with the global investment theme, a lot of traders are looking to Washington, where the annual meetings of the International Monetary Fund and the World Bank kick off on Friday. And on the sidelines, the finance ministers and central bankers of the world's largest G20 economies will also be talking separately about a coordinated effort to stave off an immediate financial crisis. That could tip not just the United States and the Eurozone, but other countries like here at home in the UK into recession. If these countries really do wish to restore a modicum of calm to markets and investor confidence, they have to act boldly and together. Only a maximum show of financial firepower now can avert a crisis. If these weekend meetings fail to produce a respectable response, then on Monday, it's not going to be a happy day in the markets. Finally, after so much doom and gloom, I've been searching for a happier note on which to end. I didn't find it exactly, but in the market, TUI Travel has issued a trading update which says the group is at least on track to meet full-year forecasts for 2011. Just as well, really, given that looking ahead to the winter and the new financial year, although it is early days yet, bookings are so far pretty slow. The market's taken a dim view of the update and whacked the shares probably a shade too much so that they're now below 140p, and that's more than 100p lower than at the start of the year. However, I wouldn't buy into TUI right now, and if you do hold the shares, just check that near 8% dividend yield is sustainable. And that's it for today, but do stay with us here online for all the latest news, and please feel free to post your comments on articles and blogs if you feel so minded. Thanks for watching, and please join us again at 11 AM on Friday.